So let's say you said, no, I'm going to stay the course. So we on the left side stay the course. March 31st, your balance is 100,000. Market went down, we discussed that. Let's say you stay in the same investments. Years later, the growth, you came back, the market came back. The retirement balance now is 400,000. So your statement, your brokerage statement, your 401k statement says $400,000. The problem with that 400,000 is not all yours. It's not. You have to share that with the IRS. And if you live in New York State or New York City, you have to share it with New York State, New York City too. So let's say that you're in the 24% bracket. That's 400,000. You have to pay tax of 96,000 on that 400,000. So what you decided to do, you said, I'm not going to pay tax on the 100 when I could have. I'm going to just ride this thing out. And you wrote your investments return. Beautiful. They returned the 400,000, but you now have to pay tax of 96,000. Let's go to the right side. The Roth, the person who said, you know what? The market's down. I'm not going to sell my securities because we don't want to do that because that loss becomes real. I'm going to transfer my 401k traditional to a 401k Roth with the same investments. So the 300,000 is the growth. So in retirement, you got 400,000. The tax rate is zero. Zero. Why is it zero? It's zero because the 300,000 is tax-free. That's the reason we did the Roth, because the growth is tax-free. And the 100,000, you already paid tax on it. So when you see your statement, Mrs. Roth person, your statement reads 400,000, but that's your money. You're not sharing that with the IRS. You're not sharing that with New York State or whatever state you're from. In addition to that, remember we talked about at age 72, you have to take money out? You don't have to take money out of the Roth IRA. It's been taxed already. IRS is not interested in it because you don't have to pay tax. So that money won't come to your return, thereby increasing Social Security, making it taxable, thereby making your medical deductions maybe not deductible because your income is higher, thereby making your premiums for Medicare higher because Medicare premiums are based on your adjusted gross income. Quick story, I have a client who does a lot of gambling, okay? He's retired. He made $200,000 gambling. So you have to report that on the face of the return. That's in the income. That increased his Medicare, that increased his Medicare premium. I was like, because we were able to work it out, but when you have more income, it jumps, your Medicare premium jumps. So the Roth IRA not only saves you the tax on 300,000, there are other benefits. But let's go a little deeper. Remember, we said if you have a COVID distribution, if you pay the money back in 3 years, you don't have to pay tax. Remember that? So let's talk about that real quick. If you recontribute the 100,000, this is the money that you converted, and you recontributed from some other source, within 3 years, that 24,000 tax disappears. So therefore, this potential savings could be 96,000. Word to the wise. The law was not written for you to take money out of your retirement account and convert it to a Roth and do what I just said. It wasn't written for that reason. However, there's nothing in the law that says you can't do it. So we have to wait to see if there's something that comes down the pipe that says, if you convert, you can't do this. But we do know that when the markets are down and you're in a lower bracket, that's the time you want to do a conversion. Why? Because of what we just talked about. Let's talk about how do we create wealth for the next generation, okay? This is bigger than a Roth IRA. This is bigger than your 401k, okay? This may be bigger than your home that you own, all right? So what if we had an investment that generates income, interest income that's free from tax, dividends that's free from tax, capital gains that's free from tax, retirement distributions that's free from tax, seed money to start a business that's free from tax, medical expenses. So the point is, we can create a vehicle that as it earns dividends, interest, capital gains, there's no tax. So what are we talking about? We're talking about having a life insurance policy that has an investment component in it. There are two types of life insurance policies. There's permanent life insurance policy and there are term policies. A term policy, as the name indicates, insures you for a period of time, a term. There's no investments going on your side. A whole life or permanent policy has two components. It has the death benefit and it also has the investment component, which we call cash value. So when you write a check for your premiums, a portion is for life insurance, a portion is for an investment. As those investments grow and they kick out dividends, capital gains, what have you, you can take that money out of the policy tax-free, tax-free. 529s are great vehicles, okay? But they may limit you in terms of what you can use it for. Let's say, for example, you're paying for your kid to go to school, but then they want to take a trip for spring break. You can't use 529 money for that, but you can use money out of this insurance policy for that. So we want to think about tomorrow so that our children, grandchildren, great-grandchildren are in a better position. So let me give you an example how this works. So let's say that we have an SU couple and they form a family trust. And they have a policy in which they have a face death benefit of $2 million, but they also have cash value. Okay, we talk about permanent insurance. We want to insure both the lives of this couple. The reason we want to do that is because we want the insurance cost to come down. And this money is for the next generation. You can do any assortment. You can have it on one person. You can do whatever you want. I just want you to understand the concept. So the trust owns the life insurance policy. There are tax benefits for that. We'll talk about that in a minute if we have time. We're running out of time right now. The trust owns a life insurance policy. When these two people transition, their children, who are beneficiaries of this trust, are going to receive some money. The instructions left by the trustee is that the children receive $1 million and the trust keeps $1 million for the purpose of buying insurance on the children for their children. So the children receive $1 million for themselves. They can do whatever they want. But we're asking them in an intelligent way to take $1 million and do for your children what mommy and daddy did for you. When you have $1 million and you buy life insurance, you can buy a whole lot of life insurance. So let's say in this example, so the children have now bought $10 million of life insurance for their children, the grandchildren of the parents. They pass away. The grandchildren receive $5 million. Again, the trust has been set up by the parents. The trustees follow those instructions. The parents have told the grandchildren through the will, not the will, through the trust document, you keep $5 million for yourselves and you go ahead and you buy insurance on yourselves for the next generation. $5 million money in insurance buys more than $1 million. So now you have 50 million. 50 million. You repeat this process for the next 20, 30, 40, 50, 100 years. What you have done is you've created a legacy without paying premiums other than the first group. Who paid premiums out of their pocket? The first group. The first group established this. They went in their pocket and paid premiums. The second, the third, the fourth group, they paid premiums, but from where? They paid premiums from the death benefit. They didn't pay premiums from their personal accounts. So what we're doing is this is a smart way to establish a legacy without paying income tax, without paying estate tax. What is estate tax? Estate tax are death taxes. When you die, your accountant is going to add up your assets. And if your assets exceed a certain value, you have to pay a state tax. That value at the federal level is $11,580,000. So if your assets are below $11,580,000, you don't have an estate tax issue. So some people say, well, why would you put this in a trust? We're putting it in a trust because the next generations, they're going to have over $10 million. In addition to that, local states don't have an exclusion that high. So you may not have to pay a state tax at the federal level, but you may get caught at the state level, okay? Some states is $1 million, between $1 million and $5 million. In addition, the law of $11,580,000 is going to revert back to $5 million January 1st, 2026. Okay? So the point is, we are establishing a trust, a legacy, a family philosophy. Okay? You can control who gets money. You may have a stipulation that you have to be of moral character. Maybe you have to finish school. You can speak to the next generation from the grave. Okay? The point is, no income tax, no estate tax. And let me tell you how it gets even better than that. Remember we talked about cash value? When you write a check to an insurance policy, there is two things that's happening. You're paying for life insurance and you're also investing. So that first group, the parents who put money in this policy, if the cash value has grown to the point where it exceeds the premiums they paid, they can take money out the policy tax-free and keep the policy in force. So what did I just say? I just said that you could set up potentially a $50 million legacy without even paying for it, because you can get the money back that you put in the policy if the investments perform. This is very heavy. It's serious. And the reason we need to do it, because let's face it, we're from the last hired, first fired community. Our people are the people who are on the front lines with COVID-19, working, driving trains, buses, and so forth, have to go to work, can't social distance because they need to make money. So what are we going to do about that other than talk about it? So this is a way for us to not just think about ourselves. This is a way, like my friend said to me, that you're solving a problem that is beyond your lifetime. But now you're thinking big, because if you're solving a problem that just pertains to your life, you're thinking small. So this is what we want to do. I started this for my family in 2006. So I'm not just talking. Okay, this is already set up. So you want to make sure you set these things up. In addition to that, there are benefits because it protects your offspring from creditors, IRS, whoever. So you're protecting, you're planning for things that haven't even happened yet. You're thinking. And your family will remember you anyway, but your great-great-great-grandchildren will really remember you. So you want to set these things up.